Hey, everybody. Welcome to the August commentary. There has really been a lot going on in markets lately. We've seen some ups and downs this past month in August. And what we're going to dive into today is really what's going on and what is in store for the rest of the year. As a reminder, this is being recorded. It will go up on our YouTube channel afterwards. There is also a Q&A box. You can type in questions throughout the presentation. Any kind of questions, I will stick around afterwards and make sure I answer. All right, well, thanks everybody for joining. There's been a lot that's happened here in August. So let's go ahead and dive into several of the topics today. We're going to look at some economic growth, inflation, the labor market, interest rates, tariffs, and of course, the stock market. A lot has happened. We saw real GDP change here. We had a negative quarter in the first quarter, and we saw a very big reversal here in the second quarter, surpassing expectations and reversing a decline, leading us further away from, of course, a potential recession, which has been talked about a lot over the second quarter. We had a very strong second quarter here with 3% GDP. So the concerns over a recession are at least prolonged for now. As far as the contributions to that GDP, a lot of that was due to businesses and households front loading purchases in anticipation of tariffs, right? We had tariffs go back into effect on August 1st, and a lot of small businesses or even larger businesses and households stocked up on certain products that might have been impacted. So we saw a increased amount of essentially imports there, a decreased amount of imports and an increased amount of exports. Now, as far as the GDP outlook goes, moving forward for the rest of this year into the next several years, we have three lines here to look at. We have in the navy blue line, we have trade deals. And then finally, we have what's called a worst case scenario, which is trade wars and persistent inflation. So in the baseline, or let's pretend that these trade deals work out nicely, both of those forecasts lead to GDP continuing upwards. But if we get into a situation with some of these trade wars, what we're looking at is later this year into next year, seeing some of that GDP come down. And a concern that a lot of us have or may have is, are we going to get in a situation where we have a recession? And we're going to talk a lot about what's going on with interest rates, inflation, and the labor market, which is also going to go hand in hand with what's going on with tariffs and what happens to markets in the short term. For those of you retiring later this year or early next year, this is going to, of course, be a very important factor that you're going to want to keep an eye on, because the last thing you want is to retire from work or from the government, and then we have a big recession or we have markets drop shortly after, especially if you're not allocated correctly in anticipation of that. So keeping an eye on these trade deals is going to be something that we really want to pay a heavy focus to, because what that GDP could do is we could see that dip down before coming up if there are prolonged trade wars, especially because we don't have trade deals with a lot of our major trading partners, Mexico and Canada being two of the main ones. And then we are still in talks with China, so that's not done yet. And those three, Mexico, Canada, and China, are our three largest trading partners. We don't have trade deals with any of them yet. So let's take a look at inflation. Now, last month we saw the first impact of tariffs on inflation. We actually ticked up a notch on essentially core CPI. So core CPI strips out the more volatile parts of inflation. And we saw that tick up a notch here in July when we look at July over July. So July 2024 to July 2025, there is a small tick up in inflation. And when we look at that, is due to tariffs from back in April. So the first signs of tariffs factoring into inflation have just now been seen from April. So that took about 3 or 4 months for that to have an effect. But we also just had a lot of those tariffs pulled off the table and then just put back on August 1st, which was effective August 8th. So it's going to take us until December or January, assuming the same timeline, for us to really see the impacts of that on inflation. And that's something that the Federal Reserve is going to be very cautious about with interest rates and them monitoring inflation here is, does this establish a trend, right? Does this continue upwards, or do we start to see this instead rather level out and maybe even continue a little bit further downwards as we get closer to the 2% target? Now, according to Deloitte, we will get closer to the 2%, but that's going to take a lot of time. So, according to a recent study by them, what they're looking at is the 2025 forecast would be 2.9%. So that would be a little bit higher than actually where we are now. They're essentially expecting inflation to pick up about 0.2% further from where we are right now. And what they're actually projecting is that next year in 2026, that due to everything going on with tariffs and the economy, that we would actually even go further up next year. So the 2026 average for the whole calendar year would be 3.2. So what that might mean is, hey, we might have these higher interest rates for longer, even if they do, which we'll talk about, but even if they do cut them next month, interest rates might stick around for quite a bit more time before they can really cut those rates down. That means for mortgages and refinancing, that might get prolonged. That means the bond market might be a little bit more prolonged. Smaller stocks, small caps, companies worth under 2 billion, those might struggle a little bit more since they tend to take more business loans. So it's, again, something we want to keep an eye on, but according to their forecasts, we might see it elevate a little bit here over the next year and a half before it starts to work its way down. And we might really not get closer to that 2% target until more like 2030, which is about 5 years out. Now, the other part is just looking at the CPI, again, the inflation index in relation to employment costs. So employment costs here is going to be essentially what employers are paying per hour of time. So under COVID, we saw a reversal here, right? We saw that the price of goods compared to the income received by employers or employees flip-flopped, right? And goods were costing more than the income that a lot of folks were making. It was a little bit of a struggle, to say the least, for a lot of people. And we saw that reverse again in early 2023. Now, a lot of us still felt the difference because it does take time for that to average out. But the forecast moving forward is for that to widen in the correct direction, which is just employment income remaining more stable and the CPI through these quantitative measures that the Federal Reserve has taken, that the CPI will decrease and we'll get back into more of a healthy economy where people are able to afford a little bit more and things are not as tight. I know a lot of that has to do with housing, which is a big contributing factor there. That is, for most people, their largest expense. And that has really taken some time to come down. So as far as inflation goes, this is going to be something that the Federal Reserve looks at, is their employment, right? That people's ability to cover or be able to afford their, especially necessities, not so much wants, but necessities. And if they need to cut interest rates to help get us to that point. Now, on the labor market side of things, we have unemployment rates still very low, right? Our unemployment rate is right now about 3.5%, and it's remained historically low. And I apologize, at 4.2 in July, but the forecasts are that that is going to try to head lower. It was 3.5 a little bit earlier, right about there. But where we are right now is we're following along with a cycle that we've seen time and time again, which leads into recessions. So all of these gray areas on the chart here, all these vertical gray areas, these are all market recessions, or economic recessions, which in turn led to some stock market pullbacks. Now, what happened prior to a recession, let's even look in 2000, is we see unemployment go down and then we see it start to tick up, right? Same thing back in the late 80s, right? We saw it go down, then we saw it start to tick up. Same thing before 2008, saw it go down and start to tick up. So once it goes down and it kind of rounds at the bottom and then starts to elevate, normally what we've seen in the past here is we've had a recession before we really see the peak or the spike. In other words, unemployment is a lagging indicator, something that happens afterwards to confirm that trend that we're in. So, what we're keeping a very close eye on right now is, do we see this unemployment start to have another spike, or do we maybe see it dip a bit lower where, hey, maybe we are going to take another notch further down? A prime example of that would be what we saw over here back in the 60s, where we saw it kind of come down. It looked like it hooked, but then it went down even further before it came up. So that gave us some extra time before there was eventually the next recession. So I will keep you guys updated, of course, on this, but it is something that you want to keep an eye out for. Is, do we start to see this unemployment number really start to spike in coming months? Because at that point, we might already be in a recession by the time that we notice that indicator. Now, the good news, right? Today is not all about bad news. There is some good news, which is interest rates. It's been a long time since the Federal Reserve cut rates. A lot of that was due to the election, a lot of the things that were talked about prior to that during the campaign, and one of those, the main one, being tariffs. Now, we have had a very strong economy when it comes to job data, economic growth. I even just mentioned earlier that our GDP went back up. But a lot of those forecasts and projections have started coming down, especially when it comes to the jobs market. And what we're looking at is the Federal Reserve very likely cutting interest rates by 0.25% here in September. So as of now, this was done July 11th here, but as of July 11th, there was a 95% probability that the Federal Reserve would cut rates next month. And I actually looked at a couple other sources more recently, and we're kind of still in roughly that same ballpark. Right now, everybody's eyes are on the Jackson Hole Lodge meeting here in August that will be, verbalized afterwards as far as what the Federal Reserve is looking at, what they're thinking. We're looking at what kind of cues or hints they give, but all signs are pointing to the fact that they cut rates once here in September. And then the focus is going to go back to, when are they going to cut them again? Are they going to continue waiting? Are we going to have another 6 to 12 month time frame before they look at cutting rates again? Or are they potentially going to even cut them again before the end of the year? There's definitely some analysts out there that think we're due for 2 cuts this year. I'm personally in the camp of thinking that we might get one here in September, but we probably won't see another one this year. And it's going to depend on, again, those larger trading partners in what happens throughout the course of the rest of the year. A cut in September will be a good thing. It will give a little boost to markets. September is also historically a very rough month. It is the worst month of the year, historically speaking, on average in the stock market. So if we look at the projections here with rate cuts, this is called a dot plot. You can actually find this on the Federal Reserve website, and they will update this roughly every quarter. Usually after they have a Federal Reserve meeting, they will come in and update where the different Federal Reserve members think that interest rates will be over the next few years and then longer term. So right now we're at 4.25 to 4.5%, right? So we're essentially right here. And what this means is that there are more Federal Reserve board members who believe that rates by the end of this year will be lower than they are right now. Now, one cut would put us right here, and we see only 2 members think that we're going to have one cut. On the flip side, we have the most that think that there will be 2 cuts. And we have a couple who are just more optimistic that we might have even a third cut. I'm in the camp of thinking that we are here with the 2, and depending on the information, we might get lucky and jump over here. Now, if you look at the history of these dot plots, and as the Federal Reserve updates them, they can change very quickly. So we want to take this with a grain of salt, but the main thing that we want to look at here is a vast majority of Federal Reserve members think that we will end the year lower than we are now. As far as next year goes, we're now jumping down into this kind of category here where the majority of them think that we're going to end in the 3.5 to 3.75 range. Meaning if we have one cut this year, we'd be having 2 cuts next year. So that's not going to be enough to really get mortgages back into the 4% and really have the stock market in this huge expansion phase, unless we have a bigger market crash where they need to cut rates faster. 2027, looking at just going one more cut further. So we're not looking at least on average, there being a significant amount of rate cuts. In other words, companies are really going to have to grow and expand for us to see markets continue to climb. Now, talking about tariffs, let's talk about probably the biggest negotiation going on right now, which is with China. So the US very recently extended the deadline with China for another 90 days, which is a good sign. They are our second largest trading partner, and that's giving a little bit more time to negotiate essentially a deal with them, which would probably be, I would imagine, one of the first deals that we'll have with the major partners. And I would actually technically almost say second, because the European Union, we did actually essentially establish a deal together with them, right? And the European Union, well, not each individual country, but the union together would also be somewhere in there amongst our top trading partners. Now, we have some good and bad news when it comes to these tariffs, which is Mexico and Canada. We, back in April, we're not going to implement any tariffs on them. We were negotiating a deal. There's actually an agreement that we have with them. And what these August tariffs brought about, I guess because they weren't playing ball to the way that the US would have liked them to, is that we are imposing tariffs on them and imposing a 25% tariff on Mexico. I think that was 30, and I think they dropped it down to 25, and a 35% tariff on Canada. So when we look at this, we don't have deals with Mexico or Canada. We are in the works with China, and of the other partners that we have, looking at, Japan and downwards, those are, much smaller partners in relation, but we are making progress. So the hope is by the end of the year, we at least have them with the top 4 partners. And if that's the case, and I think that's really what it's going to take, we might see that second interest rate cut this year. And the reason that that's important is that would help prolong the stock market to be able to continue to grow. Now, the concerns that we have about the market, and the reason that we need something to essentially come in and give us more optimism about markets, it's just the valuation. And the valuation has been consistently high for the past year. And I would even argue most of 2024, it's been very high. But the S&P 500 right now has not been this overvalued since the dot-com bubble. Now, if we think about this, let's kind of try and draw an analogy. In the dot-com bubble, there was the internet, right? There was a lot of speculation and hope that the internet was going to, and it did change the world, the way that we do things, the way businesses operate. But now it is all about artificial intelligence. And for better or for worse, artificial intelligence is changing the world. It is changing the way that we do things. It's changing how efficient somebody can be at their job, because they might not need to do a lot of redundant tasks or busy work. They can use that to help them. But just like back in the dot-com bubble, it is speculation. It is not based off of the fundamentals of these companies. These big tech companies at their very high valuations, that is not backed or supported by numbers. So it could very easily come back down. But I would say that there is one very big difference this time. And that difference is that it's not spread throughout 100+ different companies, right? Where you're trying to figure out which companies are the ones that are going to make it longer term. In this case, it's really held by those very few select larger tech companies, which are swallowing up or buying and acquiring smaller companies that are making a lot of progress in the artificial intelligence space. So I do think that we're not going to look at a similar situation to the dot-com bubble, but we are at such high valuations that at some point things need to level out and come back down at least a little bit, or maybe just trend laterally until these companies have some more revenue to support these high valuations. So when we mix that together with the time of year that we're in, right? I mentioned earlier at the start that we need something hopefully good in September so that we don't see September being this worst month of the year, right? September is, on average, over the past 20 years, negative 1% return. Now, if we look at the next worst, that would be June, which is negative 0.4. So this is 2.5 times as bad of a month on average. So should you be worried? The answer is no, because the fourth quarter is the strongest quarter of the year. And for any of you who saw last month's commentary, I know that I showed this chart previously, but I do want to kind of talk about this in a slightly different lens, which is if we see a rate cut in September, that could potentially keep September as more of a moderate month than potentially such a negative month. But it also depends on the Federal Reserve in their language, right? If they cut rates and say, hey, we're going to cut, but we're probably not going to cut again for a long time, well, that might be initially positive news. That could also be negative and create sentiment that maybe markets are not going to do as well in September because of that. So we need to be very careful here, and especially the fact that markets are just coming a little bit down from their all-time highs. And then we'll see what things look like as we head into the fourth quarter. Really appreciate everybody for joining, everybody who will be watching this after the fact. I will just turn this over for any questions. There's a Q&A box where you can find the ability to ask questions. Otherwise, thanks everybody. Hope you all have a great day.